So, welcome to the next edition of Conversations with Capita. And through these conversations, we aim to decode relevant topics on all equity and ESOP related matters. So, today we again have something very interesting and something specific to discuss about. This is related to companies that grant ESOPs to employees based in Australia. And we have Amit Majumdar, our in-house equity compensation expert at Capita, as well as he heads our business for SEA and Southeast Asia and Australia and New Zealand regions. So welcome, Amit. How are you doing?
Yeah, thanks, mate.
Thanks, mate.
Good to chat with you. So happy to be here.
Great. And yeah, something I didn't mention is Amit also lived a good portion of his life in Australia. So hence, no one better to I think decode this for us. So Amit, maybe why don't you start with that? So tell us about your time working in the equity compensation space in Australia and any nuances you want to call out.
Yeah, sounds good. So
sounds good. So thanks for this.
So I spent most of my professional and adult life working in Australia. So kind of fell into the equity compensation space. So I worked in financial services. It's a pretty interesting market. So I had a chance to work with both listed and unlisted companies across Australia and also international companies with employees in Australia. So it's quite a unique market, interesting regulatory space. A few specific rules that come into play. So things are quite quirky, unique. And I think ESS reporting is one of them. So I think it's always quite important to be familiar what you might need to take care of, and some of the things may be unexpected. And I think that's the reason why we're having this conversation. So more than happy to run through, ESS reporting requirements with you today and just try to explain all the things that, companies need to be mindful of and aware.
Great. So let's start there. So what's ESS reporting? What does it stand for, and why is it relevant?
Yeah, sounds good.
So
ESS reporting stands for Employee Share Scheme Reporting. So what it is, it's an obligation of an employer to provide both annual tax statements to the underlying employees who participate in their company's equity compensation plan. So they're often referred to employee share plans, employee share ownership plans, or employee stock option plans, so ESOPs in general. As well as report the underlying data to the local tax authority in Australia, called the Australian Tax Office or the ATO. The Australian tax year ends in 30 June. And kind of the reason why we're having this conversation now is that because 30 June just passed last week, so it's the end of FY 22-23 tax year in Australia and the start of the new tax year. With that in mind, there's actually a couple upcoming deadlines and things need to be mindful of. So it's a topical season for a lot of year-end reporting, and it also covers the obligation of companies to report relevant transactions that occur within their employee share plans for the companies.
Got it. That's very helpful to note. I mean, it's a news to me that the Australian calendar is slightly different to India and maybe some of the other jurisdictions. So 30th June is the year end. So what does now that we've crossed the year end, what does the process involve? What are some of the deadlines that are coming up that companies, founders, HR leaders, and various other stakeholders need to be aware of?
Yep, sounds good. So I think before we talk about the deadlines, it's probably quite important to also provide a bit more context in relation to why ESS reporting is a thing. So the unique aspect about Australia, obviously, there's income tax obligations for employees receiving salary, wages, or equity compensation. And what you see in a lot of countries around the world is usually employer has tax withholding obligations. So when employees, for example, exercise their options in a lot of jurisdictions around the world, the payroll or the company has obligation to withhold the relevant tax and remit that to the local tax authority. So the tax is kind of taken care of upfront, so the employees don't have to deal with it. The situation in Australia is a little bit different. There's actually no tax withholding. So on salary and wages, payroll does deduct towards at the time of the monthly payment of salary. This is not the case for ESOPs or share plans. So as a result, employees receive the full benefit. So if you have a vesting or you look to exercise, nothing actually gets withheld. So as a result, you as an individual receive the full amount you're entitled to for your specific awards. As a result, at the same time, there is a tax obligation that usually gets triggered at certain events. So from the tax authority point of view is that because employees receive everything, the obligation is for them to actually report everything at the end of the year as part of their income tax return. So because the employer doesn't have obligation to withhold earlier to care of it up front, their obligation happens at the end of the year. So their obligation is to actually report the relevant data. So that's all gets sent to the tax office and gets pre-filled in individual income tax returns. So when the specific employees complete their return in Australia, all the information is captured there. So whatever the payment they have to make to the tax authority, it's all reconciled through this ESS reporting process. So this is a unique concept. No withholding. So the result obligation in the companies is not to withhold, but to report at the end of the year. So not because your question is about the specific deadlines. There are 2 days that every company needs to be mindful of. So one of them is 14th of July, which is next Friday, and the other one is 14th of August. So 14th of July is the deadline for a company to issue their employees who had the relevant taxing point that needs to be reported to the individual. So they need to produce an annual tax statement and issue that to the employees before next Friday. So they have, if your company has that specific requirement, you're going to have a week to get it organized. The second deadline is 14th of August. So by that time, the ATO, the local tax authority in Australia, needs to receive the underlying information. So Shrikant, if you're an employee of a company and you are Australian tax resident based in Australia and you had a tax import that needs to be reported, so what you can expect next Friday is receive the statement that outlines the relevant figures that need to be reported. And then me as a company, as your employer, I have an obligation to report those same numbers and figures to the tax office by 14th of August, so a month from now. So what that happens is when you're going to do a tax return, which is generally due in the end of October in Australia, if you do it yourself, unless you use your accountant, is that the ATO by the time knows exactly what was reported. You have a statement with the same numbers. When you do a tax return, everything reconciles and it's up. And that information we as a company, as an employer report at ATO actually gets pre-filled in your return. So that way, when you do your tax return, you log in the relevant boxes, the numbers will be pre-filled, and you have the supporting document, which is the ESS statement, the annual tax statement that reconciles that. So this is the process that follows, and these are the deadlines the companies need to be mindful about.
Got it. Thanks, Amit. So this 14th July and 14th August, I think the two big dates, I think the audience listening to it or catching up later should be aware of. And just one clarification here, Amit. I think you mentioned it a bit, but does this apply only to Australian companies or anyone? I mean, can you elaborate more on that, whether it's all employees or just the companies? Yeah.
Yeah, so which might be a surprising thing is that it doesn't only apply to Australian companies. So it applies to any company, even like, let's say, company in the United States, UK, India, Singapore, Indonesia, Malaysia, anywhere really around the world that has employees in Australia who received equity compensation or ESOP or share plan awards. So if you have Australian employees, even if you're an international company, this might come as a surprise, but you do have reporting obligations as an employer, which can be a little bit tricky, especially if you don't have much of a presence in Australia. But these are the requirements that apply to all employers. Obviously, a lot of Aussie companies, Aussie startups, and listed corporations are well aware of these requirements. So that falls part of their annual governance and tax reporting year-end checklists. But for a lot of international companies, it can be a little bit tricky, especially if you only have a couple of employees as well. You still want to ensure that, obviously, when it comes to tax, it's pretty important. So you don't want to ensure that your employees are not aware of the requirements, right? You want to support them through the process. That's the whole point of the ESS tax statements. The other thing, if you read the requirements on the ATO's website, there could be penalties that could be applied if you don't fulfill your obligations as an employer. So it kind of goes both ways. It's very important for the company to be aware of it and complete this process. And also very important for employees, because obviously it's their obligation to complete their annual tax return and report the relevant information.
Got it. Thanks, Amit. That's helpful to know that it also applies to non-Australian companies but having Australian employees. And just to clarify, like, are these obligations similar or different for startups, listed companies? You want to elaborate on the concessions provided for maybe one of the startups? Or
Good question. So if you oversimplify it, the requirements are consistent across the board. So no matter if you're a small, large company, listed, unlisted, ESS reporting obligations are quite broad and consistent. So the 14th of July, 15th of August deadline, the requirement to issue statement is the same. There are some nuances. In Australia, there are tax advantage plans. So if certain companies meet certain criteria, they may qualify for what's called ESS startup concessions. So as a result, they can offer specific types of ESOPs or share plans that take advantage of certain tax benefits and as a result. So for example, in some cases, if you offer options in a startup that qualifies for startup concessions, the actual requirement and the tax employee doesn't fall on exercise and is not going to be reported as income tax. The employees will actually be required to pay capital gains tax at the end. So there's some benefits of this. And in Australia, like if you pay capital gains tax for an asset you held over 12 months, you get a 50% discount. So there are certain benefits to pursue startup concessions. However, the obligation to report still remains even for startup concessions. So the unique thing for startup concessions, the reporting for ESS actually happens in the year of grant. So even though the actual taxing point for employees will be ultimately when they sell, you actually need to report the relevant amounts on allocation in the year of allocation, in the year of grant. So for example, Shrikant, if you're an employee who received options on their ESS startup concession plan, let's say in March this year, me as your employer, I actually have to report that underlying data of the grant you received for FY23. So I have obligation to do it by next week. So the question might be, why would you do that if taxing point is years down the track? But the concept here is that you report essentially the cost basis that will be used to calculate the relevant, capital gains for startup concessions in future once you ultimately dispose of those assets. So that's probably more of a unique thing for startups because a lot of them kind of pursue that startup concession plans. For a lot of other companies that follow the more conventional plan designs or they're not eligible for startup concessions, the taxing point can still fall under allocation in some cases, like tax-exempt plans, or in most cases, it's deferred up until exercise on sale. So in those cases, you need to see which taxing point triggers happen during the year for your allocations, for example, exercises or sales, and report those accordingly. So there are nuances depending on design of the plan for the specific company. But if you oversimplify it, if there's a requirement to report, you kind of follow the same process. You still need to issue the statements by 14th of July. You still need to report the data by 14th of August to the ATO.
Got it, Amit. So thanks for decoding those nuances. Quite helpful. The other question that get asked is, is this something that companies need to continue doing every year, or is this like a one-time?
Yeah.
On that,
Good question. So it is an annual reporting obligation. So every financial year to go through the process. But important thing to note, you may not need to actually report something every single year. So, as an example, you offer startup concession in options under startup concession. You only need to report in the year of allocation. So if between FY23, even though you have an existing plan with awards, but you didn't allocate any options under this plan, there's not going to be any reporting obligation there because it's reported in the year of allocation. Right. So even though you still need to check if any allocations have been made, you may not need to report anything. But it's also important to do this annual review. For any other non-startup concession plans, you need to monitor to see were there actually any reportable transactions during the year. So maybe if there's no exercise, no sales, nothing that triggers a reporting point of view, you may not need to actually issue any statements. However, you still need to do those checks. There could be other circumstances where you still go through the checks, but maybe there will be nothing to report. So for example, there are certain rules around mobility. So in certain cases, if your Australian employees were actually based somewhere else, you're an Australian company, but your overseas employees are mobile and overseas, there may be nothing to report as a result of this. And also important to note, there are other examples where not every single type of ESOP or share plan is actually eligible or considered under Division 83A in Income Tax Act of 1997 as an employee share scheme. So examples of what plans are not considered ESS and as a result are not captured as part of this requirements are loan share plans, or premium priced options are also not considered. So as you can imagine, the answer to your question, is it something companies need to do every year, is yes. They need to check to ensure that they have something to report, but it could be circumstances like no taxing points occurred, or you have overseas employees with no reportable transactions, or your plans are not even required to be reported. In those cases, maybe no data needs to be reported, but it's always important to do the checks every single year.
Got it. Thanks, Amit. That's again good to know that this is how the obligations align every year. And so the next question, now that we covered a lot on why is it relevant, who is it relevant for, now let's get into the process, right? So now let's say the reporting is required. The first step that you mentioned is the ESS statement, right? That, so how does that work? Like how does this report or the statement get generated? You want to talk about that?
Yeah,
Yeah.
that's a good question. So the process is a little bit complex. So first of all, once you do your annual review, you just need to identify the relevant transactions. So there's certain rules you need to follow to see what kind of information gets reported. So the first deadline, as we talked about, is producing the statement. So what we can do, we can just briefly I'll flash the template that ATO actually provides for the annual tax statement, and I'll just highlight a few things to give you an idea what kind of information needs to be captured and what's actually reported here. So what we'll be showing on the screen now is like a template of what an employee share scheme statement looks like for the year end. So on this statement, the things that you as a company's employer have to capture is employee details. So the relevant address, their tax file number in Australia, which is the Australian tax ID for individuals. And as you can see on the screen, we have a few kind of reportable, boxes of information with values that needs to be reported. So on the left-hand side of the statement is anything that falls under non-startup concessions. So any taxing points for in boxes D, E, F, and C. Around any kind of deferred taxing points or anything else that needs to be reported for transaction that happened during the year. And should your plan fall under startup concessions, you need to report the details of allocated awards on the right-hand side of the plan. So it'll be either or. So your plan will either fall under or under startup concessions or not. So as a result, you just need to provide the relevant totals that needs to be sent to the ATO as well. Obviously, the calculations underlying are a little bit more complex, so you have to figure out exactly what values to use, what dates to report. But actual statements for employees is pretty straightforward. All it tells them is that here's your details, and we have on record in our payroll, and here's the total either quantities or dollar values that you need to include in your tax return. So employees, it's actually pretty straightforward to follow. Best practice is you also provide them the underlying breakdowns. So they don't get just the total dollar value, but they also understand how it was arrived to, how it was calculated, what share price was used, what fair market value was utilized. But this is the initial process. So to kind of explain how it works, on 30th of June, you should complete the review of your employee share plan history and transactions to understand exactly what the reportable items are. And after that, complete the necessary calculations and produce those statements. By 14th of July, you need to deliver those statements to the employees. And then you have a month to the data you already should have in place, but to complete that lodgement with the ATO. So that's the high-level process. But as you can imagine, each scenario is a little bit unique. Calculations can be a little bit complex, but that should hopefully give you the high-level process of how it exactly happens.
Great. No, thanks for actually bringing the form up and going through the key aspects. And so, what's next then? In this whole process, reporting this data to the tax office. How does one go about that? You want to touch upon that?
Yep.
You're on mute, Amit.
So sorry, mate. Click the wrong button. So yeah, look. Once the statement has been produced and issued to the employee, the underlying reporting to the process can be done both by the company themselves. There's actually ways to self-lodge it, or you can utilize support of third-party vendors who can actually complete that lodgement for you as well. So once again, depending on the scale and population, you may not actually be able to complete it on your own. So that's why you need help of third-party vendors to assist you with this. So for example, if you only have a couple employees, the process is relatively straightforward. You'll be able to do so yourself on your end. However, if you deal with hundreds of employees, obviously it's impossible to potentially even produce the statement because you may make mistakes. So it's always good to involve someone else to help you with the calculations and actually can assist you with the actual lodgement with the ATO as well. So once again, if you're not sure about this process, I'm more than happy to kind of reach out to us. We'll guide you through it. We can put you in touch with the relevant people who can assist you with this, depending on your specific circumstances. But once again, if you're an early stage startup, You just need to do a little of reading, and the ATO website is actually really good. Provides a lot of information, provides detailed step-by-step guide exactly what you need to do. If you don't have time or capacity to do it yourself, you can always outsource it to a partner to help you on that front as well.
Wonderful. So yes, do reach out to us and we can guide you, help you in the right direction. Amit, you want to also touch upon some of complications or some complexities involved in this, call out some of these use cases for our audience?
Yep, sure. So look, in most cases, especially for startups and startup concession plans, the reporting is actually relatively straightforward because you simply kind of report the information of what was allocated to the employees. So it's not too complicated. When you deal with non-ESS startup concessions, that's when things get messy because you need to identify those relevant taxing points, do the relevant calculations. So that process is not straightforward. So I personally have been kind of doing ESS, reporting since 2012. So it's been more than 10 years. So for me, I love this stuff. It's complex, it's fun. But the first time you're doing it, it's kind of confusing. The rules are not straightforward to follow. Thankfully, the government actually in Australia made some changes. So the actual reporting obligations are a little bit more simple with the recent changes. However, yeah, it's still not something that can be intuitive. But to your point, there's other things that can overcomplicate things. So there are things you need to be mindful of is, for example, and also something I mentioned before, if your Australian employees are mobile, they spend a portion of their time on overseas assignments, right? Or they leave the country and start living somewhere else. That can be a little bit tricky because I might need to work out the portion of the income tax amounts that need to be reported in Australia, which may not be the full amount. So you need to kind of track the allocation history and figure that out as well. The other things you need to keep in mind is that you need to keep your records as a 30 June year end very clean. Because, for example, if you realize that there was a mistake made and the underlying ESOP data needs to be updated, you might actually need to go and amend the statements you previously issued. There are some cases when you issue awards that are defined as indeterminate rights, which means is that it's an instrument that's settled in shares, but a company has the discretion to settle it in cash. This qualifies as if the plan rule has that provision for board discretion, it's classified as indeterminate right. So in the result, the income tax for the deferred taxing points is actually triggered at the point where employees actually receive the shares. Otherwise, it's actually going to be reported in payroll as like salary and wages as well. So that can be a little bit tricky to track, and it's something you need to keep in mind of. Another aspect is in Australia, there's both income tax and capital gains tax. And there's a certain rule that if you sell your shares within 30 days of your deferred taxing point, your deferred taxing point actually changes to the sale. So in most cases, for example, for options, which are non-startup concessions, when you exercise, it usually triggers the taxing point. However, if you sell those underlying shares within 30 days, the taxing point is not an exercise, it's actually sale. So the 30-day rule is an important one because it can make it a little bit tricky. And there could be like nuances when you exercise, let's say on 25th of June, but you sell your shares on 10th of July. Because it happens across 2 taxing years, FY23 and 2024, for example, you just need to be mindful of this, like when to report as well. The other aspects in, Australians love their trusts and different vehicles. A lot of share plans can be issued in the name of associates. So, for example, it could be your super fund or family trust as well. So there are certain rules that apply to it, and the actual ESS reporting, because it's issued to you because of your employment, the ESS statement is issued in the name of your individual, even if your options, for example, are held by the relevant trust as well. So there's some nuances there that can be a little bit tricky. So that's something you need to be mindful of as well if your plan rules allow that. If your company is international, and you have Australian employees, usually the share price of that company could be in USD, INR, GD, GBP, any other currency as well. But because you're reporting in Australia, you actually need to convert everything in AUD. So there could be FX implications, right? So how do you convert the relevant share price on exercise? What FX do you use to convert the strike price or excess price, which could be in another currency as well. So the FX can be a little bit tricky when you do the calculations on how much to report as well. And there could be other aspects, for example, generally when you exercise your options, it triggers a taxing point, right? But what if there's additional restrictions or blackout periods preventing you from sale? of those underlying shares, so that they can actually defer your taxing point a little bit later. So to summarize, these are just some of the examples I can sort of think of that can make things a little bit more tricky, right? So as a result, like, it's always good to sort of get a good sense of your underlying data and transactions. And like, if you're not sure like what you're dealing with, obviously, happy to provide some guidance on this as well. So reach out to us, and we're gonna more than happy to guide you through it and run through all the examples and the relevant information. But a good starting point, if you go to the ATO website, if you just simply Google ATO ESS reporting employee obligations, there's a whole lot of good materials that you'll be able to find that actually pretty good. So the ATO has done a pretty good job trying to explain it. But having said that, as I've tried to allude to, there's still a few quirky things that can come up that can make things a little bit more messy that we would have liked.
Wonderful. I think we've pretty much covered a lot of ground on this topic today. I think right from looking at who is it eligible for, and now decoding all the steps, and now also some of the complications involved as well. So Amit, we kind of come to an end towards on the discussion on this topic. So any last things you want to say about how any inputs to the companies looking to complete this now? Any other things you want to add before we end?
Yep. Yeah, so the most important thing is to be aware of these rules, right? Because it's quite important, right? So it's an obligation for you as an employer to complete this, and also it has a really big impact on your employees, because obviously it impacts their income tax returns as well. So it's not something you should dismiss, and definitely something you need to be very mindful of. Especially if this is news to you, you weren't aware that this is something you have to complete in Australia. Considering it's 6th of July today, there's like just over a week left before the first deadline. It's probably a good time to just look into it specifically. Best advice is obviously familiarize with your requirements, understand your plans, your data, where your employees are, if they're in Australia, their mobility. So my best advice is to do the homework to understand the rules, and also for this year maybe a little bit too late, but for next year actually start the process a little bit earlier. So as you start approaching year end in May, June, start preparing to understand, okay, what are my obligations? What do I actually have to report potentially this year? So when the time comes when in July and August, you don't have to scramble, do it last minute, trying to figure out exactly, am I in a position to meet my obligations? So you start early. So that would be my general advice. But look, like I said, we're, within our team, we have experience, working on ESS reporting for a number of years. We assist our existing clients on this front as well. So I'm more than happy to have a chat. So reach out to us. We'll try to understand exactly what you're dealing with and provide you support at the next steps you might need to follow from their point on.
That's wonderful, Amit. So definitely, I think people tuning in or listening to this later, if you need any help with or have any questions further on this, do reach out to any one of us, and we'll be able to guide you. Yes, so Amit, that was a wonderful conversation. I learned a lot, not something that I knew beforehand, not a jurisdiction I was very, very aware of. So good to understand the various nuances around ESS reporting with the deadlines approaching. So yes, I hope you have made note of the deadlines and what you need to do in order to comply by these rules if you have Australian employees in your company. So on that note, Amit, really thank you for making time for this and decoding this for us today.
Nice. Thanks, mate.
Wonderful, and thanks again for everyone tuning in. And if you have any other topic in mind that you want us to cover, we are all ears to that, and we'll definitely incorporate those in the subsequent editions. So stay tuned to Conversations with Capita. Thank you.